Investing is simple, but it is not easy, as emotions can distract you from making the right decisions. Let us see how a typical investor behaves at different stages of the market ups and downs. In conclusion, don't fall into the trap of greed and fear which makes you buy high, sell low. Instead, take a rational view of the market and stick to the principle of buy low, sell high. There are a lot of such intuitions that spoil your investments and wipe out your wealth. Investors tend to sell off whenever there is a slight panic in the market, and investors buy irrationally when there is a slight rise. Let us take a look as to why does this happen.
I know everything about markets by watching TV.
Many people believe they are experts by merely watching the market news on television. Do not forget that there are thousands of people who follow the same market.
Last year too, it hit 52-week low and went up by 20%. And the same will happen now.
Too many times people get fixated on the past and expect that the same would happen again. Understand that past events or trends may not repeat.
I will invest my principal in large cap and interest on small cap.
Stop all mental accounting and treat each penny equally instead of separating on the basis of where it has come from and where it is going to be spent.
Sir, your portfolio is up by 10%. Sir, your portfolio is down by 10%.
What? This is unacceptable. I am going to sue you. This example makes you understand the problem easily. People feel more for a loss than for a gain of similar magnitude.
In addition to these, there are 4 major reasons that lead investors to make wrong decisions. These are herding, that is, following the crowd, emotions, overload of information, and preconceived opinions.
Always think twice before you make a decision. Double check whether it is due to biasing towards a trend or getting influenced by someone else's decisions. Also, short-term ups and downs are regular in market. Do not panic during such times and patiently wait to see your investments grow in long term.
Let us now look at the various investment styles. Let us first look at value investing.
I bought this plot for just 25 lakhs. Once the new airport gets sanctioned, the price will be double at least.
Wow, that's awesome. I will also buy.
Just like buying a property that is currently undervalued in the market, buying stock that is currently undervalued is called as value investing. Here, undervalued means stock price is less than intrinsic value. Characteristics of value stocks are sound underlying business, promoters' integrity, and competent management. Business trading at prices lower than intrinsic value, have low debt, and are cash-rich. Moving to second investment philosophy of contrarian investing. Let us look at the conversation between Kishore and the shopkeeper.
The woolen sweater is really of premium quality. I will buy it.
What? Why do you want to buy a sweater in the scorching summer season?
That's the secret. Since it is off-season, sweaters are now available at less than half the price at which we can buy in winter.
Wow, you are really smart. I will also buy one.
This is how the contrarian investor invests. When the market looks highly optimistic and people are buying, the contrarian investor would sell. When the market looks highly pessimistic and people are selling, the contrarian investor would buy. Coming to growth investing. Let us look at the conversation between Shyam and the property dealer.
This area has seen a 10% growth in the prices in the past 1 year. In the next 1 year, it will go up by 20%.
Wow, that's great!
Here, as Shyam is willing to buy the property even though the price has risen, with the belief that it will rise further. Similarly, growth investing is the technique of investing in stocks that have significant growth potential in future. Characteristics of growth stocks are: these are consumption-driven. These are small or mid-cap companies. Early-stage companies with potential to grow. Has high PE ratio. Growth is underestimated and it has high expected earnings growth.
The value investors seek companies those seem to be undervalued by the market based on fundamentals like earnings, dividends, book value, cash flow, etc., and therefore have the potential to increase in share price when the market corrects its errors in valuation. Growth investor believes that growth in earnings and/or revenues will directly reflect into an increase in the stock price. As opposed to value investors, growth investors tend to pick companies trading higher than their intrinsic worth, believing that their worth will exceed the current valuation. Contrarian investors do exactly opposite of what masses do when it comes to buying or selling stocks. This philosophy is based on a fact that other investors tend to overreact to the valuation of stocks, thereby taking the selling stock to the undervalued position and rallying stock to the overvalued position. Visit investment reports and get to know great ideas to make sound long-term investment decisions. Visit Direct Speak and watch our experts give their valuable insights about latest happenings from the world of investing and markets. Enroll and attend live e-classes straight from our research experts. अब इन्वेस्टिंग सिंपल है